You wake up one morning, check the price of your home, and it's gone up by $20,000. No renovación. No extra work. No new value created. Just a higher number. Feels like you made money. But here's the uncomfortable question. Who actually paid for that? Because when asset prices rise across an entire economy, homes, stocks, land, it's not just a story of wealth being created. It's a story of wealth being redistributed. Quietly, systematically, and often invisibly. And once you see the mechanism behind it, it becomes hard to look at rising prices the same way again. Right now, in most economies, asset prices have been climbing for years. Housing, equities, even collectibles. The headlines call it growth, prosperity, a strong market. But beneath that optimism, there's a pattern. The people who already own assets keep getting richer, and the people who don't fall further behind. Not always dramatically, but consistently, and it's not random, it's structural. Let's start with something simple. Imagine two people. One owns a house, the other rents. The price of housing goes up 10%. The owner's net worth increases. On paper, at least. The renter? Nothing changes except their future cost of buying just got higher. Same economy, same price movement. Two completely different outcomes. Now scale that up. Millions of homeowners, millions of renters. Every time prices rise, wealth shifts subtly but steadily toward those who already own. It doesn't feel like a transfer, because no one sends a bill, no one writes a check, but the gap widens anyway. So what's actually driving this? Why do asset prices keep rising in a way that seems to favor owners? The answer isn't just demand. It's the system that determines how money enters the economy. Most people imagine money flowing in from salaries, production, or government spending. But a large portion of money enters the system through something else. Credit, loans, mortgages. Think about what happens when someone buys a house. They don't show up with cash. They borrow. The bank creates a loan, and that loan becomes new purchasing power. New money entering the market. Now imagine thousands of buyers doing the same thing, all armed with newly created credit, all competing for a limited number of assets. Prices rise, not just because people want homes, but because they now have more money to bid with. Money that didn't exist before the loan was issued. This is the first layer. Credit expansion pushes asset prices up. But here's where it gets more interesting. Who benefits from that price increase? Not the new buyer, at least not immediately. They just took on debt to buy at a higher price. The real winner? The previous owner. They sell into a market inflated by credit. They capture the gain, and they walk away with the difference. Now take that same logic and repeat it over and over, across years, across cycles. Each wave of credit pushes prices higher. Each price increase rewards existing owners. Each new buyer enters at a higher level with more debt. It's a ladder, but the rungs keep moving upward. There's also another layer most people don't see. Leverage. When asset owners borrow against their assets, something unusual happens. Let's say you own a home worth $200,000. It rises to $300,000. You now have $100,000 in additional equity. You can borrow against that, extract cash, invest it elsewhere, buy another asset. So rising prices don't just make you wealthier on paper. They increase your ability to acquire even more assets, which benefit from future price increases. It's not just growth, it's amplification. Meanwhile, someone without assets doesn't have that option. They can't borrow against a home they don't own. They can't tap into rising equity. They're locked out of the mechanism, watching prices rise from the outside. This is where the system starts to feel asymmetrical, because rising prices create more opportunities for those already inside, and fewer opportunities for those still trying to enter. Now layer in monetary policy, interest rates, liquidity, central bank actions. When rates are low, borrowing becomes cheaper. More credit flows into the system. More money chases assets. Prices rise faster. When markets wobble, support often arrives. Liquidity injections, stabilization measures, policies designed to prevent collapse. And where does that support land first? Financial markets, asset prices. It's not a conspiracy. It's a side effect of how the system is designed. Stability often means supporting asset values, because falling asset prices can trigger wider economic damage. But that also means something else. When the system is protected, asset owners are often protected first. There's an irony here. Rising prices are often framed as a sign of success, a healthy economy, growing wealth. But for many people, rising prices don't feel like success. They feel like distance, like something moving further out of reach. Because if your income doesn't rise as fast as asset prices, you're not keeping up. You're falling behind, even if nothing in your daily life seems to change immediately. And this gap compounds over time. Just like interest, asset owners benefit from price increases. They gain equity. They gain borrowing power. They gain access to future opportunities. Non-owners face rising entry costs, higher barriers, more debt required just to participate. Two groups, same system, very different trajectories. Now zoom out. This isn't about individual decisions, or personal discipline, or even timing. It's about the structure of money creation, credit, and asset markets. A system where new money often flows into assets first, where rising prices reinforce existing ownership, where access determines outcome. And once that cycle starts, it feeds on itself. Higher prices justify more lending. More lending pushes prices higher, until something interrupts it, or slows it down. But even when the cycle pauses, the gains from previous cycles don't disappear. They stay embedded in balance sheets, in property values, in portfolios, which means the system doesn't reset. It builds, layer by layer, cycle by cycle. And that brings us back to the beginning. That $20,000 increase in your home's value. It didn't come from nowhere. It came from a system that continuously channels new purchasing power into assets and rewards those who already hold them. So the next time prices rise, and it feels like wealth is being created across the board, it's worth asking a quieter question. In a system where rising prices make asset owners richer by design, who's actually funding those gains? And how long can that dynamic continue before the gap becomes too wide to ignore?